There's another real estate concept with real estate rentals called active participation, which allows someone to deduct up to $25,000 of rental real estate losses. So active participation is defined as someone that is active in the property through making management decisions. What should the rents be? Who should the tenants be? What sort of expenses am I going to pay? They're making management decisions regarding the property. And so if you do that, you're considered an active investor. Even if you have a property manager managing your company, you still can be considered a active investor if you're making those type of decisions. So that's the standard you have to meet. If you meet that standard, then you're eligible to deduct up to $25,000 of rental real estate losses if, again, we get back to this $150,000 threshold of adjusted gross income. So if you're, the first step is, can I qualify for active status? If I can, now the second step is, am I eligible to deduct these losses? And you are, as long as your income's under $100,000. If it's over $150,000, your income, adjusted gross income, then you're not eligible to deduct these $25,000 in losses. So let me give you an example. Let's say that someone has $25,000 in losses because they own 3 rental real estate properties. And let's say that they make $125,000. So they're midpoint between the $100,000 and the $150,000 threshold. So because they're halfway there, or 50% there, they're eligible to deduct 50% of the $25,000, or $12,500. So again, the first step is, do I qualify to meet this active status? And if I do, what type of income am I making? If I make over 150 and I'm not eligible to deduct these losses in this year. If I make something less than 150, then there's a phase in or phase out of how much I can deduct.